Hello all and welcome to session 11 of Direct Tax 2 of the fourth semester BCom of Mangalore University. We are now moving to the next unit, that is depreciation. Now depreciation is a very important concept as far as business and profession income is concerned. It is more so covered under Section 32 of the Income Tax Act. And in this particular session, we are going to cover the meaning of depreciation, what do you mean by block of assets, and what are the income tax rules as far as Section 32 is concerned. Now, what is the meaning of depreciation? The commonly used meaning of depreciation is it refers to decrease in the value of an asset. Asset is used, asset is unused, but due to a fluxion of time, due to passage of time, due to better technology, obsolescence, the value of the asset, existing asset will come down. And how much the value of the asset comes down, that portion or that amount is called as depreciation. The value of assets, both tangible and intangible. So we also cover intangible assets like copyrights, trademarks, patent rights, franchises, designs, logos, all these are intangibles. They also decreases due to continuous use over a period of time. So what is the basic essence or basic idea of depreciation? We say it is the estimated cost of the expired usefulness of an asset. An asset when purchased, it is estimated that it will be used for certain number of years, say maybe 10 years, 12 years, whatever may be the case. Once that 1 year or 2 years or say 1 year is over, you attach or associate a value for that expired usefulness, and that cost attached is only an estimation. That's why we call depreciation as the estimated cost of the expired usefulness of the asset. Now, as far as Section 32 is concerned, that is of the Income Tax Act, we don't deduct depreciation on individual asset basis. We deduct depreciation on what is called as block basis. We say block method of charging depreciation. What do you mean by a block of assets? It simply means a group of assets belonging to a particular class having the same rate of depreciation. I can give you an example. Let's say in our business, we have the electrical fittings, say like switch box, tube light, say fan. All these are electrical equipments. Apart from where the rate of depreciation is 10%. Similarly, we have furniture, we have tables, we have chairs, we have sofa sets. All these are also part of furniture where the depreciation rate is also 10%. So what do we do is, instead of charging depreciation on electrical equipment separately, on furniture, table, chairs separately, we combined all these assets together. We group all these assets together. That's why it is called as a group of assets belonging to a particular class. The class is furnitures, fixtures, and fittings, we say, put together and having the same rate of depreciation. That is called as a block of asset. So a group of assets belonging to a particular class having the same rate of depreciation, it is called as block of assets. And as I mentioned earlier, depreciation under Section 32 is deductible under block basis, not on individual asset basis. So now how do we calculate the written down value for depreciation? As usual, written down value as on 1st of April 19, that is on the first day of the year, that will be given to us in the problem. Whatever purchases or additions that have been made during the year will be added, and it will be totaled with the opening value, the written down value at the beginning of the year. Then if there is any sale proceeds, that sale proceeds of the asset will be deducted. Remember, it will be deducted. Sale proceeds of asset will be deducted, and whatever value that will remain over here, that will be the value on which we are going to calculate depreciation, and that is written down value for depreciation. That's how you calculate the WDV for depreciation. Staying with the concept of block of assets, this is very, very important. If a full block of asset is transferred and the amount received is less than the written down value, let's imagine the written down value of the block of assets, let's say furniture, is around 2 lakh rupees, and the entire block is transferred, is sold, and amount recovered, let's say, is only 1,80,000. So entire block is sold and the amount received is less than, definitely 1,80,000 is less than the block value, which was 2 lakh rupees. Then the difference of the amount, which is around 20,000 rupees, that will be a loss, and that loss will be treated as short-term capital loss. It is to associate it with the chapter capital gain, where we are going to discuss two kinds of assets, short-term and long-term capital asset, and the resultant gain or loss arising is short-term capital loss or long-term capital loss, or short-term capital gain or long-term capital gain. So in case of block of assets is transferred, entire block is transferred and the amount received is less than the written down value of such a block, then the loss, the difference of the amount not covered from that transfer, will be treated as short-term capital loss. Exactly the other way, where the amount received in respect of transfer of full block of assets or a part is more than the written down value of that block, then the excess amount that is recovered shall be treated as short-term capital gain. Again, let's take example. Suppose the opening block value of the machinery is around 4 lakh rupees. And let's imagine there are 3 machines in that block and 2 machines are sold, and the business gets say 4.5 lakh rupees. Though there is one asset still in that particular block, 4.5 lakh covers for the entire block value of 4 lakh rupees, but it is 50,000 more than the block value which is recovered, and that extra 50,000 will be treated as short-term capital gain. That's about the block of assets. Now, very, very important point. Difference in depreciation rules in case of accounting and depreciation rules in case of taxation. Section 32 of the Income Tax Act, what does it say about any new asset purchased during the year? It says, if any asset is purchased during the year and used for 180 days or more in the previous year, I stress, used for 180 days or more in the previous year, then full year's depreciation is deductible. So 180 days is the magic number. 180 days or more in the previous year, a new asset is purchased, and if it is put to use for a minimum of 180 days or more, it can be 180, it can be 185, it can be 365 also, used for 180 days or more in the previous year, full year's depreciation is deductible. But if the same asset is purchased and the period of use of the asset is less than 180 days, suppose the business is purchasing an asset from October 4th onwards. So October 4th till 31st of March, if we calculate, the total number of days is around 178, 179 days. And definitely it is less than 180 days in the previous year, then half year's depreciation is deductible at the rates prescribed. So let's understand this very clearly. So meaning to say, if the business is purchasing an asset on 4th of October and any day thereafter in the previous year, definitely the number of days that the asset may be used will be less than 180 days. So half year's depreciation will be charged. Whatever is the rate of depreciation on that block of asset into half will be levied. So even if we purchase an asset, let's say on 1st of March, and we use it only for 31 days, since it is less than 180 days, half year's depreciation will be levied. Now, these are the important rules as far as depreciation under section 32 is concerned. So thank you.